Hey everyone, welcome back to Corporate Decoder, the place where we translate corporate mumbo-jumbo into plain English. Today we're diving into American Rebel Holdings' latest report. Buckle up because this one has more twists than a country road and maybe even a hint of trouble ahead. This video will unpack their recent financial performance, some potential risks, and whether this patriotic brand is truly standing its ground or just digging itself a deeper hole. Before we jump in, if you are into clear insights into corporate reports, make sure you're subscribed. We also have a Discord community linked in the description below where you can chat with other investors. American Rebel Holdings, based in Brentwood, Tennessee, sells safes, security products, and even beer. They aim to embody American values, targeting customers who love freedom and the Second Amendment. Let's look at the unaudited balance sheets, comparing March 31 of this year to the end of the last year. First, cash and cash equivalents, the most liquid assets, increased slightly from about $288,000 to $341,000. Not a massive jump, but still positive. Accounts receivable, money owed to them, also went up a bit, from $1.7 million to $128 million, a good sign indicating steady sales. However, inventory decreased from about $4.6 million to $4.20 to $22. This could mean they're selling more product or they are producing less. We'll look at revenue shortly to understand which it is. Overall, total assets dropped from $10 million to $9.7 million. This is a signal that the business might be shrinking a bit. Let's flip to the liability side to see how they're managing their debt. Accounts payable, what they owe to suppliers, increased from $3.19 million to $3.42 million. This could indicate some cash flow pressures as they're taking longer to pay their bills. A big one, accrued interest. The interest they owe on their debts jumped from $1.26 million to $1.71 million. This signals that debt is becoming more expensive and harder to manage. Loans for working capital decreased from $4.9 million to $4.6 million. While some was paid off, it was replaced with other liabilities that increased the overall amount of the debt. Zooming out, total liabilities increased slightly from $17.64 million to $17.72 million. This large liabilities balance is a major concern when their assets are less than $10 million. The total stockholders' equity, or rather deficit, worsened slightly, remaining deep in the negative at around negative $8 million. This basically means the company owes far more than it owns. Now let's move to the income statement where we can assess how they are doing with sales and expenses. Revenue for the 3 months ended March was $2.51 million, down from $4.04 million in the same period last year. That's a roughly 38% decrease, a significant drop. This confirms that less inventory sold was a product of lower revenue, not a plan. Cost of goods sold also decreased but didn't shrink as much as revenue did, a 31% decrease. This points to potential inefficiencies in production or higher input costs. Gross margin, the money left over after cost of goods, was just $289,000, dramatically lower than the $841,000 last year. This confirms that their sales and production are becoming less profitable. Consulting, payroll, and other costs actually increased to $729,000 from $552,000, meaning more costs with less revenue. Marketing costs nearly tripled, jumping from $265,000 to $695,000. It seems they're spending much more to attract fewer customers. Interest expense also rose significantly from $424,000 to $724,000. As the company takes on more debt, interest payments become a bigger burden. Finally, the net loss before taxes ballooned from $27 million to $6 million. It is a clear trend that the more this company is doing, the more money it is losing. Ultimately, the net loss was also $5 million versus $2.7 million. The company is burning cash at an alarming rate. Now, let's look at the cash flow statements to see where the cash went. Net cash used in operations was negative $546,000 compared to negative $1.9 million last year. This metric is showing less cash was burned compared to last year, product of lower revenue and increased accrued expenses. Net cash provided by financing activities was $602,000, quite a bit down from the $1.4 million. This is an indicator that it might be more difficult to access cheap debt in the short future, a critical concern given other parts of the report. Overall, cash increased slightly by $53,000, a temporary relief for now, as operating and investing activities are negative and rely on financing. The loss per share worsened, reaching 23.45 compared to 27.27 last year. A lower number is a positive thing here because it's negative. Also, the fully diluted loss per share is based on only 215,747 shares, making it a very unreliable comparison, given that there are 6,515 TED and 17,538 and drinking 35 outstanding shares on May 14, 2027 last year. A lower number is a positive thing here because it's negative also. Now let's move on to some major red flags identified by the auditors. The auditors clearly state that these factors raise substantial doubt about the company's ability to continue as a going concern or stay in business. This is about as serious as it gets. Of course, it gets better when we see lawsuits and payment defaults. There is the notice of a trademark complaint from Liberty Safe, and Bank of America has filed a complaint in the 4th Judicial District Court in and for Utah County, State of Utah, case number 2501345, against the company and its subsidiaries. And in short, the company's situation is looking really dicey. What's the story here? American Rebel is banking heavily on future growth fueled by debt. But sales are down, expenses are up, losses are mounting, and they are in default with at least one creditor. The company's been relying on debt and stock issuances to stay afloat, which is not a long-term strategy. And a final word for the wise, the SEC documents are full of the statement, these are all forward-looking statements. So take everything you see with a grain of salt. Now, looking at these results more broadly, American Rebel seems to be struggling. While their brand might resonate with some, their financial numbers are simply not good. Their debt levels are very concerning. Losses are piling up, and they might not be able to continue operations. Given all this, an investment in this business would only be justified at a very low price, one that takes into account all of the serious risks the company is facing. Alright, that's our breakdown of American Rebel's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.